Thank you very much for taking time to listen to this message today. I am Karaoka, Representative Director, President, and CEO. From now, please let us explain the financial results for the fiscal year ended on January 31st, 2026. First, we will outline the 4 main points of today's presentation summary. First, regarding the fiscal year ended January 31st, 2026 results. Our adjusted indicators, which reflect our underlying business strength by excluding one-time M&A-related expenses, show adjusted EBITDA of 22.8 billion yen and adjusted net income of 9.4 billion yen. Both figures successfully met our initial targets. This achievement was driven by a dual-engine strategy of M&A and organic growth. Key contributors included the expansion of Gigo exclusive prizes, the integration of karaoke equipment dealers, and growth in our foreign currency exchange machine business. Second, regarding the fiscal year ending January 31st, 2027 forecast, we are revising our consolidated EBITDA target upward to 30.0 billion yen, a 2.0 billion yen increase from our previous guidance of 28.0 billion yen. This reflects the full-year contribution of M&A deals closed in the previous fiscal year, combined with robust organic growth in our existing businesses. Furthermore, as we deepen our engagement with capital markets, we are implementing several key updates this fiscal year. These include transitioning to IFRS, shifting our guidance exclusively to adjusted indicators to better illustrate our core profitability, and refining our capital allocation strategy with a more disciplined approach to M&A. We also remain highly focused on our continued inclusion in the New Topics Index starting this fiscal year. Third, regarding our North American business, we are revising our targets. For the first half of the fiscal year ending January 31st, 2027 downward to reflect the ongoing implementation of countermeasures following last year's operational issues. However, we expect operations to return to full normalcy by the second half of this year. This will allow us to close the gap with our midterm business plan within approximately 6 months and remain on track to meet our original targets from the next fiscal year onward. We have already taken radical steps to address the primary challenge, a shortage of time allocated to prize restocking caused by operational changes during the integration of 5 North American entities. Specifically, we developed and launched Kiddleton Force, a dedicated business app for North America. By integrating the AI-driven route and restocking optimization we perfected in Japan, we will standardize and streamline our field operations. Fourth, regarding our shareholder return policy. Following a significant improvement in our financial foundation through positive free cash flow, we have decided to initiate dividend payments. Our objective is to broaden our investor base. While we will continue to prioritize growth investments, our basic policy is to deliver disciplined annual dividend increases. On the other hand, we view share repurchase differently from typical shareholder returns. For us, treasury shares are a vital currency for future M&A. Therefore, we will execute repurchase opportunistically and flexibly whenever our valuation is deemed lower than its intrinsic value. Our goal here is to acquire M&A capital at a discount. By utilizing these shares as M&A consideration after the stock price appreciates, we can effectively reduce our acquisition costs and ultimately drive further enhancement of shareholder value. We would like to explain the full-year earnings results. Starting with this earnings release, we have consolidated our financial reporting format to better reflect our company's actual performance. Under the GAAP section, the figures currently follow Japanese accounting standards, which include one-time M&A-related expenses and the amortization of goodwill and intangible assets. These items will no longer be presented following our transition to IFRS in the fourth quarter of this fiscal year. Conversely, the non-GAAP section presents our intrinsic performance by excluding those one-time M&A-related expenses. These indicators do not treat goodwill or M&A-related intangible asset amortization as expenses, providing a clearer view of our underlying business strength. Moving on to our consolidated statement of income. Revenue reached 170.7 billion yen, up 152.7% year-on-year, YOY. Adjusted EBITDA rose to 22.8 billion yen, 148.6% YOY, while adjusted operating income grew to 13.3 billion yen, 127.2% YOY. Adjusted net income resulted in 9.4 billion yen, 155.6% YOY. Throughout the year, our domestic amusement business maintained a high growth rate for existing store sales. Next, let us explain the strategy for our core business, our domestic amusement brand, Gigo. In the prize game segment, which continues to show strong momentum, we are focusing on our key differentiator, maximizing the lineup of Gigo exclusive prizes. Last year, we launched an impressive 200 exclusive items. By expanding these exclusives to stores acquired through M&A, Gigo brand recognition has doubled over the past year. We believe this virtuous cycle is successfully maximizing the experience value for our customers. In our karaoke business, we have pursued a roll-up strategy at the storefront level, while also moving upstream in the supply chain through strategic M&A. We welcomed Onsu, a leading equipment dealer, into our group 2 years ago, followed by Kaji Corporation last year. The restructuring of these two companies has led to the birth of Yenni Company Limited. With a managed base of over 30,000 units, Yenni has become the undisputed #1 leader in the industry. Next, we would like to explain our foreign currency exchange machine business. Last year, we acquired this business at an attractive valuation of 4.7 times EV to EBITDA. Since joining Genda, the business has achieved exponential growth through the application of our proprietary technology. The most significant achievement has been the AI-driven optimization of our collection and replenishment routes. This DX initiative has delivered an exceptionally high ROI, resulting in year-on-year revenue growth for every single month since the acquisition. In terms of profitability, EBITDA grew to 1.5 billion yen in the fiscal year ended January 31st, 2026, up from 1.0 billion yen prior to the acquisition. Furthermore, we are forecasting a significant increase to 2.3 billion yen for the current fiscal year, the fiscal year ending January 31st, 2027. This fiscal year, we plan to aggressively increase the number of units deployed, focusing on major domestic retail chains. While our overall corporate policy is to be highly selective with organic growth investments, we will prioritize the expansion of this business due to the high IRR and ROC we expect it to generate. Next, we will walk you through our balance sheet. On the asset side, while active M&A has brought goodwill to 50.6 billion yen, we maintain a comfortable buffer of approximately 15.0 billion yen relative to our net assets. On the liability side, financing for these acquisitions has resulted in interest-bearing debt of 112.4 billion yen, with 32.4 billion yen. In cash and deposits, our net debt stands at 80.0 billion yen. Our net debt to EBITDA ratio, a key indicator of our debt capacity, is currently 2.7 times. However, due to our updated free cash flow policy, we expect the debt associated with our existing businesses to begin trending downward from this fiscal year. Consequently, we are confident in our ability to maintain ample debt capacity moving forward. Furthermore, our M&A strategy is executed with rigorous discipline. Despite having completed the highest number of M&A transactions among listed companies for 3 consecutive years, our goodwill impairment since founding has been extremely limited. Moving forward, in line with the shift in our free cash flow policy, we will further tighten our investment discipline regarding existing businesses as well. Next, let us explain our full-year earnings forecast for the fiscal year ending January 31st, 2027. Reflecting our exceptionally strong current organic growth, we have revised our earnings guidance upward. We are raising our consolidated EBITDA forecast to 30.0 billion yen, up from the previously announced 28.0 billion yen. While there is a downward revision of approximately 1.0 billion yen in our North American operations, the growth in our domestic business is significantly outpacing this, driving our overall performance. We now anticipate net income of 10.6 billion yen. Please note that following our transition to IFRS in the fourth quarter, EBITDA is expected to exceed 45.0 billion yen due to the on-balance treatment of operating leases. Regarding the fiscal year ending January 31st, 2027 forecast, we have revised our EBITDA guidance upward to 30.0 billion yen. Compared to the 22.0 billion yen recorded in the previous term, we anticipate a year-on-year increase of 8.0 billion yen, a 36% growth rate. This represents a period of significant transformational growth for our company. This achievement is the direct result of two factors. The full-year contribution of the 26 M&A transactions we executed last year, with a total investment of 1.7 billion yen in related expenses and organic growth that continues to exceed our initial expectations. By transforming these one-time expenses into a powerful engine for growth, we will continue to accelerate the enhancement of enterprise value through disciplined investment. Here is a breakdown of our business portfolio. The amusement arcade segment continues to be our core driver, accounting for approximately 70% of both total revenue and profit. Moving forward, we will maintain our focus on platform-based M&A as our primary growth engine. Simultaneously, over the medium to long term, we will accelerate our expansion into the content sector to broaden our value chain. This slide shows the transition of our revenue breakdown. In our core amusement and karaoke businesses, we have successfully achieved steady, transformational growth through our strategic roll-up approach. This is the quarterly breakdown of our consolidated forecast for the fiscal year ending January 31st, 2027. As in typical years, our performance will be heavily weighted toward the second half. Only in the first quarter, we expect adjusted net income to decline year-on-year. This is due to several factors. The second half seasonality of our newly acquired photography studio and European segments, as well as Gyaga film lineup, which is more heavily concentrated in the second half of this fiscal year compared to the previous one. Starting from the fourth quarter of this fiscal year, we will adopt International Financial Reporting Standards, IFRS. The transition to IFRS will result in the discontinuation of approximately 5.0 billion yen in annual amortization of goodwill. Additionally, due to the on-balance treatment of leases, our current estimates suggest a significant accounting uplift, an increase of over 15.0 billion yen in EBITDA, and over 5.0 billion yen each in operating income and net income. Going forward, to more clearly illustrate our intrinsic performance, we will limit our earnings guidance to three key metrics: revenue, adjusted EBITDA, and adjusted net income. Under this new policy, one-time M&A-related expenses incurred during the period will, in principle, no longer trigger downward revisions. Instead, the model is designed such that every acquisition of a profitable company will result in an upward swing relative to our initial forecasts. Furthermore, in line with the practices of other active M&A-driven companies, our adjusted net income will now add back the amortization of M&A-related intangible assets, just as we do with goodwill. Please refer to the appendix for further details. This slide outlines the revision of our M&A strategy, which we first announced during our third quarter earnings briefing. Previously, we prioritized the speed of our M&A and conducted public offerings for 2 consecutive years. However, we have now established a firm policy. We will not conduct any public offerings for the purpose of securing M&A standby funds for at least the next 3 years. By being highly selective with our acquisitions and aiming to generate 5.0 billion yen in free cash flow from our existing businesses next term, we are transitioning into a phase of self-sustained growth. Furthermore, we are strictly enforcing a disciplined approach where we only execute M&A that is EPS accretive. We project an adjusted EPS of 57.71 yen plus additional upside for the coming fiscal year. Next, we will provide an update on our North American business. We have revised our target for the fiscal year ending January 31st, 2027, originally disclosed in the second quarter, downward for this fiscal year only. While the cause was a temporary opportunity loss due to operational issues during the integration process, we have already implemented countermeasures. We expect operations to normalize in the second half of this fiscal year and return to the original midterm plan's trajectory from the second half onward. We still forecast significant growth in North American revenue, reaching 45.0 billion yen, an increase of 164.0 billion yen compared to the previous year's 28.6 billion yen. This growth is driven by a 10.6 billion yen contribution from the full-year consolidation of M&A executed last term. On top of that, we will achieve 5.8 billion yen in organic growth through a combination of operational improvements, the add-on initiative, and the rollout of exclusive Japanese IP prizes. The specific measures are listed here. We will walk you through the details starting on page 28. We will now explain our first key initiative for the fiscal year ending January 31st, 2027 operational improvements. On the ground, we faced a critical challenge with insufficient prize restocking. Specifically, we discovered that restocking at our swap locations was inadequate. In response, we conducted a comprehensive inspection and rapid replenishment across all sites. Thanks to these high-speed efforts, we were able to complete restocking in time for the Christmas season, and as a result, our performance trends began to improve in December. However, our next challenge was determining how to maintain this level of consistent restocking on an ongoing basis. Upon closer inspection of our field operations, we identified the root cause, the mandate for daily bank deposits. As we prepared to integrate 5 North American entities, we applied a rule from Player 1, where staff-attended stores are the norm, to NEN's unmanned locations, requiring all collected cash to be deposited daily. This forced staff to spend their time on unfamiliar banking tasks, causing the frequency of store visits to drop by 40%. Consequently, they simply could not keep up with prize restocking. To break through this situation, we dispatched about 10 Japanese experts, primarily AI engineers, for a 3-month mission. Furthermore, in February, both CSO Habara and I spent 2 weeks each on the ground in North America, personally overseeing the development and implementation of our countermeasures. To eliminate the root cause once and for all, we are implementing a dramatic operational overhaul powered by our AI-driven business app. First, we abolished the physical burden of daily bank deposits for our unmanned locations. In its place, we have launched Kiddleton Force, a new application where AI provides precise operational instructions. Through this app, an AI agent sends optimized tasks directly to staff smartphones. They simply follow the guided workflow. This has standardized our field operations rounder duties, establishing a system where anyone can manage store maintenance and prize restocking with high efficiency. Let us provide more detail on Kiddleton Force. Because Japanese IP prizes are high-velocity items, maintaining an optimal restocking frequency is essential. Furthermore, to maximize sales, we must ensure these prizes are displayed in the most attractive manner possible. To achieve this, we launched this app to centralize all field operations onto a smartphone. By integrating the AI expertise we have already proven in Japan with Gigo Navi and our foreign currency exchange machine business, we will rapidly standardize operations and resolve existing bottlenecks. We would like to introduce the specific features of the app. First, the app provides daily guidance on which stores to visit. Our AI processes a vast array of variables, including prize sales velocity, cash accumulation levels, travel times between locations, and specific contract terms with each site. Based on this data, the app displays the optimal daily agenda, showing exactly which stores to visit and the shortest route to take. By doing so, we are thoroughly eliminating the inefficiencies that used to arise from individual discretion, allowing us to maximize the travel efficiency of our entire field workforce. Once a field merchandiser arrives at a store and taps the Start button, the app displays a prioritized task list and a machine inventory list arranged in the optimal work order. On-site staff simply need to upload before and after photos of the prize restocking to complete the entire reporting process. We have consolidated these reporting tasks, which were previously fragmented across multiple apps like Microsoft Teams, into this single, streamlined platform. As a result, we have significantly reduced administrative overhead at headquarters while gaining the ability to easily monitor whether proper restocking is being performed across all 12,000 locations in the US. Furthermore, we have transformed the reporting process for machine meter readings. Previously, staff had to manually read and enter these figures into Excel. Now, this is completed instantly through photo uploads and AI image recognition. This eliminates manual entry errors and significantly reduces labor time, allowing our field merchandisers to focus on higher value tasks. This concludes the introduction of our business app, Kiddleton Force. Additionally, we are committed to establishing a rigorous training system. We conduct online training sessions 4 times a week for our field merchandisers. These sessions cover everything from basic to advanced site visit protocols, including specific techniques for displaying prizes in our claw machines. by presenting concrete best practices versus common pitfalls. We are ensuring that behaviors designed to maximize customer experience value are deeply embedded within our entire U.S. workforce. Our next initiative focuses on new store openings. Driven by the surging demand for Japanese anime IP and the expansion of our network through M&A, we are seeing a rapid acceleration in bulk installation contracts with major U.S. retail and entertainment chains. Regarding Walmart, as previously communicated, we are strategically withdrawing from small spaces with only 1 or 2 mini claw machines. Instead, we are pivoting to open new, larger-scale locations in tenant zones that are 5 to 10 times larger than before. Furthermore, we are making significant progress with other major players. We have signed an agreement with AMC, the world's largest cinema chain, to open 170 locations, with installations set to be completed by April. We have also secured a contract for an initial 85 locations with Applebee's, a restaurant chain with over 1,500 outlets across the U.S. We will now discuss our add-on initiative, which is designed to enhance the profitability of our existing locations. This strategy involves the additional installation of claw machines and other equipment into our current mini-location network. The primary advantage of this approach, compared to our swap initiative where we replace entire machines, is the lower upfront cost and significantly faster return on investment. Furthermore, the newly added machines act as a draw for customers, creating a synergetic effect that boosts the sales of pre-existing machines at the same site. Of the approximately 1,700 eligible locations, we plan to implement this at roughly 800 sites within this fiscal year, with the goal of completing the rollout across all locations by the end of the next fiscal year. Next, we will talk about the strengthening of our prize strategy, which leverages our expanded network following recent M&A. With a network of over 12,000 locations across the U.S., our increased purchasing power has enabled us to roll out numerous Genda Americas exclusive prizes featuring Japanese IPs. The share of Japanese IP prizes in our total procurement has risen dramatically. What was 0% only 4 years ago reached 54% in the fiscal year ended January 31st, 2026. Moving forward, we aim to further increase this ratio to a level of 60% to 70%. As a new pillar of our product strategy in North America, we have launched our highly anticipated figure line. While our inventory has historically focused on plush toys, we are now introducing Figuno, our first ever series of high-precision figures. Despite their compact size, these figures are characterized by their intricate sculpting and detailed coloring. We have launched the first collection featuring characters from My Hero Academia. We plan to release new installments in this figures series consecutively, further enhancing the value proposition of our prize offerings in the North American market. As you can see, our internal pipeline for Japanese IP prizes is exceptionally robust. We will continue to unveil an exciting lineup of new products as they become ready for release. Leveraging our extensive North American network, we are committed to delivering a diverse range of world-renowned Japanese IPs directly to local fans. In conjunction with our first ever figure rollout, we have launched a full-scale advertising strategy. Historically, our primary customer base has been impulse players, shoppers who happen to be at a mall and decided to play a claw machine on their way. With the introduction of figures, we are now shifting our focus to capturing destination customers who visit our locations specifically to obtain a certain prize. To achieve this efficiently, we are deploying digital marketing techniques that have already proven successful at Guigo in Japan. This includes Pulse, our proprietary ad delivery system that automatically maximizes advertising volume based on real-time inventory levels, ensuring we drive foot traffic with high precision. This next initiative is designed to maximize revenue with zero additional capital expenditure by utilizing our existing large-scale claw machines. We are introducing high-demand, large-sized Japanese IP prizes that leverage our superior procurement power. At our test locations, this strategy has already resulted in a 1.3 times increase in sales. We are moving quickly to complete the rollout across all 3,500 target locations by the end of April. We are also improving our cost structure through organizational restructuring and other initiatives. Effective March 1st, we consolidated 14 North American entities into just 3, optimizing our management resources. This integration is expected to yield cost reduction synergies of approximately 930 million yen annually from this fiscal year onward, driven by workforce rationalization and the consolidation of non-life insurance policies. We will now share some specific examples of how we are leveraging AI across the entire group. Starting with Gigo, we have introduced AI cameras in our stores to analyze customer flow and drive sales growth. As shown in the example on this page, by using AI-driven traffic analysis to optimize our floor layouts, we achieved a verified 8% increase in claw machine sales. Next is a case study from our photography studio business, Carrot. We have implemented a system where an AI agent handles customer calls, instantly transcribes the audio into text, and notifies our staff. By eliminating the need to interrupt customer service to answer phones, we have empowered our staff to concentrate their resources on providing high-quality, in-person hospitality, which is the core of this business. The following slides are excerpts from previously disclosed IR materials. As you can see, Genda is aggressively implementing AI-driven operational improvements across our diverse portfolio of businesses. Finally, we would like to talk about our shareholder return policy and shareholder benefits. Our core strategy remains the achievement of continuous transformational growth through a combination of M&A and organic expansion. Accordingly, we will continue to prioritize the allocation of cash flow toward growth investments. On the other hand, with the aim of expanding our investor base, we will initiate dividend payments totaling approximately 1.5 billion yen starting from the fiscal year ending January 31st, 2027. As our ability to generate cash flow strengthens, we anticipate a disciplined approach of annual dividend increases. Through this policy, we expect to attract a new segment of investors, including institutional investors for whom dividends are a key decision-making factor, as well as individual investors looking for long-term holdings. This is scheduled to take effect starting with the interim dividend of the fiscal year ending January 31st, 2027. Regarding our shareholder benefits, we have decided to revise the terms for their use at Gigo. While focusing usage specifically on claw machines, we are increasing the daily usage limit from 500 yen to 1,000 yen. Additionally, we are expanding the range of choices to include gourmet popcorn from Hill Valley and lemonade from Lemonade by LaMonica. These revisions will apply to shareholders on record as of the end of July 2026. That concludes today's explanation. Genda remains fully committed to pushing forward with maximum effort throughout this fiscal year. We thank you for your continued support and look forward to sharing our journey with you.